Hey, it's Asha Avdika, founder of Rise to Learn. And in this video, I want to share with you how to trade options, more specifically the vertical spread. And the vertical spreads are fantastic option spreads to trade when you're looking to trade larger dollar stocks, because it allows you to use less capital for trading those bigger stocks. So first I want to show you the diagram behind what it looks like in a simplified version. Then I want to show you on the charts exactly what you're looking for. All right, so before we get into the vertical spread, I want to talk about the regular call spread. First off, this is called a profit picture if you've never seen one before. And a regular call spread, you have one call that you're purchasing and you're looking for a directional bet to the upside. So here you can see that we have a max loss of about $250, and that's the amount that you pay for your regular call. Now, if you buy one, deep in the money, it's going to be more expensive. If you buy one further out, it's going to be less expensive. If you're looking to buy more time premium, it's going to be more expensive, and so on and so forth, going with basic option concepts. Now, the thing that's attractive for the regular call spread is that the maximum profit is unlimited, and that's why most people get it. Now, unfortunately, the downside behind this is that you have theta decay or option premium decay. It's kind of like buying a coupon. It's worth a lot more at the beginning when you have 4 to 6 months to use it if you're trying to sell it to a buddy or a friend. Now, if it only has 1 or 2 days remaining, it's not worth as much because there's probably not a lot of people that want it. They might not be able to use it, and so on and so forth. But most people, they only know one way to trade, and it's a very simple directional way. And in this case, it's just simple. It's you buy a call spread, so you're looking for the upside. Now, when we're going into a bull call vertical spread, things are slightly different. What's different here, as you can see, is you have a capped or a maximum profit that's limited. It's kind of like a ceiling. You can't go past it. What you're doing here is, rather than just buying a call spread for direction reasons, which would be this area here, would go for the upside, you're also selling something a little bit further out. In this case, something right around the $65 area, because you don't expect things to go infinitely up. Now, the great advantages behind the bull call vertical spread is that you're able to still capture the direction or movement of the stock. You're not also limited to volatility risk in options, or very minimal. It's very limited. You don't also have the theta decay or premium so much. Now, you do if you're more towards the maximum loss area, but once you're in the safe zone, in the maximum profit area, let's just say somewhere around $60 and over, you can just stay there until the option deteriorates and collect premium. So looking at a real trade example, I'm going to show you Amazon how to set up a bull call vertical spread. So first thing that we're going to do is we're going to set up a regular call spread. And to do that, we're going to click this one right here, and let's just say we'll do the 355. We buy a single, and then we'll analyze the duplicate trade. Now, when we analyze the duplicate trade, this is what we get. We get a single option contract at $355, and we pay $15.90 for it. Now, since options come in lots of hundreds or 100 shares, this is going to cost us, if you look down here, $1,590 if the stock goes against us. Now, this white line right here is the current price of what's happening in the market. So this is your current value of the option. The red line here is the option value at expiration. So over time, this option contract actually starts to deteriorate. If I move the date forward, you can see that it slowly deteriorates and gets closer and closer. So we'll go to today, and you can see that this happens right here. Now, to offset this risk, which is the theta risk, that's the amount your option will deteriorate every single day, we're going to add another option contract, and we're going to sell one at a further price. So let's say we don't believe Amazon will get to let's just say 370 level or something like that. We'll do a sell a single, and then we'll analyze the duplicate trade. So now this gives us a new profit picture like this. You can see that I have a single here that I'm buying at 355 as the strike price, and then I'm selling a single at 370, which is $8.70. So it's selling at $870, and this one I'm buying at $1,590. So now my max loss is $720 at expiration, and my max profit is capped at $780. Now the stock can go up to a certain break-even point, which is this little area right here, which is the difference, and I'll break even at $362.18 about right there. So after the stock passes this point, and let's just say it's moving over to $364 a share, and once the stock gets here, and if it stands still, I will make money every single day, because what happens to the option over time is you can see that I'm moving the date. You can see that the white line slowly gets closer to that red line, and reality is the white line, but expiration is the red line. So you can see that there's huge advantages to getting in this region or area for your stock. Now, going back to today, you can play around with this profit picture and these different strike prices if you want. So for example, let's just say I move the strike price, the one I sell, at $365, and maybe move the other one to $350. And now you can see the stock doesn't have to move too much, for me to make a profit. Of course, it's better if it goes to the upside, then I'll make a profit. But if the stock goes to infinity, my max profit would still be, the difference between those two. So at this point, since I changed the prices, it would be $690 and my max loss at $810. So that's basically a bull call vertical spread, and that's how you set one up. If you want to do one quicker, you can just right click and buy a vertical and go there and change your strike prices on what you want to do, and then do the same thing at right click and analyze duplicate trade. Now you can see it already does all the calculations for you, and then when we analyze this, it'll give you one nice solid picture with one nice entry right here, so that way you can just manipulate the strike prices and you don't have to make individual orders. So of course you can do it very deep in the money, and then you're already in that area of profit where the stock doesn't have to move, but it's better if it does, and you have a little bit of cushion. Or you can do it further out to something like 375 and 370, where now the stock actually has to move quite a bit for you to make money. Now here you have option deterioration, so it just depends how much you want to risk, because here if you do it very far out, you can see that there's $168 at risk, but your profit potential is $332 if it gets to around 376. Personally for me, I usually like to do one a little bit closer, and I'll start with maybe 3 or 4 or 5 contracts. If you you can go more if you want, and that way, as the stock price is increasing, you can take one off to start. If you just do one contract, you're not going to be able to take one off into profits or strength. So that's just a little thought for you on how you can structure your option contracts. Thanks for watching, and if you enjoyed this video and you want to take your trading a little bit to that next level, if you want to watch the stocks that I'm watching and you want to see the trade setups that I'm looking to execute in the future in the current market conditions, then go ahead and sign up to my daily recaps. Just click this link right here and sign up to the newsletter list, and you'll get notified when I release the daily recaps. And it'll be a great trading insight for you to see exactly what's happening in the current market conditions. Now, if you want to take your trading to that next level, if you want to accelerate your learning curve, you can check out some of the courses that I have at tradersfly.com. Thanks for watching, and remember to do what you love, contribute to others, and most importantly, live life abundantly.